Saturday, November 17th, 2018, Monaco 64, home of alternative economics and contrarian views. This morning I want to talk about the futures market, cover the commitment of traders report or COT report for silver and gold on the CME or COMEX futures market. I want to talk a little bit about futures and options. I've got an old book here I bought in the early 90s when as some of you know, I worked for over 20 years as a futures and options broker. I've been involved trading and broking futures and options for, well, I started out in the late 80s. Even when I was at university in Switzerland, I knew someone who who was a broker in Geneva, and I went to his office and I started trading options back then. And then eventually I became a futures and options broker. I'll talk a little bit about that. I want to talk about the charts. I'm going to look at the gold-silver ratio, the gold price, the silver price, and I want to look at the Dow, the S&P, and the NASDAQ. And I'll look at a headline I've seen this morning from Bloomberg, which I think might be significant for what happens next week. Billy is here this morning, so we are a little later today, mainly because it's a weekend. But and I'll probably be doing a live stream sometime this weekend. I haven't decided yet, so keep an eye out for a notification. I will put it up in advance when I'm going to be doing the live stream. So futures and options. Well, first of all, I like to say that prior to the Bretton Woods agreement being ripped up by President Nixon in 1971, most futures market were for, how can I say, agricultural commodities. And why was that? Well, since the 1800s, when the Chicago Board of Trade was formed, futures and options evolved, and it was mainly because of the risk, farmers had, and people who bought the farmers' crops, the risk they had with the weather, and if it was going to be a bad crop or whatever, and farmers wanted to make sure they fixed the price in the future so they could organize their balance sheets, so to speak. A lot of them had, loans to banks, mortgages for the land and the farm. So they had to, have a fixed price for their crops. And the futures market was a good way of, how can I say, working out, managing that risk. And the buyers, of course, were mainly big companies that used to buy the food companies or merchants, distributors. They if they thought the price was a good price that they could sell higher, they would buy it. And then you had speculators as well, who were there just to make money on the movement of the price. But they had to be careful because there's a finite amount of crops. They couldn't go short wheat, massively, because if they would eventually need to deliver that wheat, and if there wasn't enough wheat in the world for them to deliver, they had to be careful. So yeah, there were speculators. What do speculators do? Some people might say, well, it's not a useful function for society. Well, actually they do provide a useful function. They provide liquidity to the end users and the farmers. It's easier for them, the farmers and end users of the crops, or even not only crops, other agricultural goods like pork bellies and cattle. So up until the 1970s, if you talked about commodities, most people thought about agriculturals and things like that, not financial. And why not? Well, because the financial sphere, prices were, or interest rates were very stable, currencies were fixed, bond markets were fairly, how can I say, stable, because we were under a gold standard. There was an anchor to the financial system. So the futures and options and the on exchange that we see nowadays for currencies, for interest rates, for stock market indices, for bond futures, all those things didn't really exist prior to the 1970s. And that has been like a development because of the fiat money system, because the fiat money system is so unhinged and so there's no anchor and so unstable that financial managers, money managers, they've had to start using futures and options and other derivatives to kind of hedge a man-made, how can I say, risk, which is a monetary system that, frankly, is fraudulent and needs a reforming. Some people argue even that the futures and derivatives market have become so big that it's like the tail wagging the dog, and that's how they can control prices of bonds, precious metals. And I wouldn't dispute that, actually, because usually these futures contracts are very leveraged. You don't need to put 100% down of the nominal amount of asset that you're going to control. Usually it's only like 5%, not even 10%. So it's very, very leveraged. It's not like when you buy a T-bill from the U.S. government, you buy $100,000, you have to pay $100,000. When you trade the T-bill futures, you only have to put like $5,000 for $100,000. So the leverage is even bigger, and these futures contracts are used a lot by the powers that be to manipulate the price. So today, hopefully this wasn't too long-winded, but I wanted to explain to you what these futures and derivatives were. So I've got this book here, Options, Futures, and Other Derivative Securities. I bought that in 1993. Do I recommend you buy that book? It's not really a book to read for fun. It's more technical. So if you are looking to get into futures and options, I guess I recommend it. They probably have a brand new edition. This is an old one. But I'll just read here the definition of a futures contract. So it says a futures contract, like a forward contract, is an agreement between two parties to buy or sell an asset at a certain time in the future for a certain price. Unlike forward contracts, future contracts are normally traded on an exchange. To make trading possible, the exchange specifies certain standardized features of the contract. The two parties to the contract do not necessarily know each other. The exchange also provides a mechanism which gives the two parties a guarantee that the contract will be honored. So that's on an exchange. The over-the-counter, there's no standardization, there's no guarantee. And what about options? Well, it says here, options on stocks were first traded on an organized exchange in 1973. So you notice there, 1973. What happened in 1971? Bretton Woods, right? Nixon closed the gold window. Since then, there has been a dramatic growth in options market. Options are now traded on many different exchanges throughout the world. Huge volumes of options are also traded over the counter by banks and other financial institutions. So the basics of options. There are two basic types of options. A call option gives the holder the right to buy the underlying asset by a certain date for a certain price. A put option gives the holder the right to sell the underlying asset by a certain date for a certain price. So that's an option. And you have options on futures as well. What about open interest, which is something we're going to look at today? It says here, it's the total number of contracts outstanding. It's the sum of all the long positions or equivalently, it is the sum of all short positions. Because of the problems in compiling data, the open interest information is one trading day older than the price information. While for the case of gold and silver futures, it's a few days, because they take the closing on Tuesday and they publish the data on the Friday afternoon. So that's open interest. One thing I found interesting in this book that I just saw now is at the end of the book, it talks about credit risk. And I'll read here. The main overall concern of bank regulators is to ensure that a bank's capital reflects the risk it is bearing. The traditional approach they have adopted has been to specify minimum levels for balance sheet ratios as equity to total assets. This has become inappropriate in recent years because derivative securities such as swaps and options, which do not appear on the balance sheet, they're off balance sheet, have begun to account for a significant proportion of the total risk. A new scheme proposed by our friends at the BIS, Bank for International Settlements, has achieved widespread acceptance by central banks throughout the world. In this scheme, each on and off balance sheet item is assigned a weight reflected its relative credit risk, and minimum levels are set for the ratio of bank capital and total risk weighted exposure. So it's funny they were talking about that back in 1993, and you can see what happened in 2008. The other thing it says here is that it's much easier to regulate the exchange traded derivatives, like the futures and options on exchanges, than the over-the-counter derivatives, because the data is public information, and the exchange basically regulates the transactions. OTC, is just between two counterparties, and only those two counterparties know what they're doing. And it's off the balance sheet as well. And so are, exchange traded derivatives. The banks don't keep it on their balance sheets for some reason. A month ago, people noted that for the first time in many years, the commercials, which are the bullion banks and who usually control the market price, they had gone long for the first time in many years. And then in the last month, the commercials started decreasing their longs and increasing their shorts for both gold and silver. So we've been following this, and so the CFTC published the data yesterday. So I've got here only futures open interest, because there's a publication of futures and options open interest combined, but we'll only look at the futures. So as of the 13th of November, which was closing day on Tuesday this week, this is what happened to the commercials, and it's very interesting, and it might explain why we saw the markets, precious metals, rally after the 13th. So the commercials decreased their short position by 10,959, which is quite significant, because it was almost at 100,000. It was at 98,000. And they increased their longs by 3,385. So net, that was almost a 15,000 contract switch to long. So right now, commercials are long 82,163 and short 87,110. So they're still net short, but that was a big move this Tuesday. And I think that's one of the reasons why the price has rebounded since Wednesday. Gold, same story. So the commercials, they decreased their shorts, not as much as silver, but they decreased it by 8,856. But they increased their longs by 27,457. So that's like a 33,000 contract switch. And they're almost now equal, the long and short positions. they're still short 203,177, and they're long 201,354. But as you can see, there's like over 36,000 contract switch, position switch. So it's quite significant. So it will be interesting to see how we, gold and silver evolve this coming week. So now I want to look at the charts. Let's have a look at first gold. This is a daily chart going back to around the beginning of 2017. And I've got the 50-day, the 100-day, and the 200-day moving averages here. The 50-day is the black, the orange is the 100-day, and the green is 200-day. So gold has managed to rebound above those 50 and 100-day, but it's still very far away from the 200-day. So it's still not out of the woods yet. One thing I noticed is gold managed to close above the 1212, 1213 area, which was a key level, has been a key level for the last month or so. And we closed at 1221. On the week, it was up about 1%. So pretty good, how can I say, week for gold. As you can see, since the bottom in August, we've had higher lows, and higher highs. So it's looking fairly good there technically. Let's have a look at silver, which of course is not doing as well. And I'll talk about that ratio as well in a minute. But silver just around the 50-day moving average here, as you can see. So it's still got a long way to go. We made a new low since the low we had in 2015, December 2015. But one could argue that this could be a double bottom here. I mean, it went through the low from the 9th of 11th of September, 9/11. But sometimes these double bottoms or double tops, they don't work exactly to the exact cent. So another a good week for silver as well. I think it was up about 1.8%. So the gold silver ratio, yeah, I mean, we haven't seen levels like this since the I think early 90s, since I bought this book. So yeah, I mean, could it go higher? Of course. But longer term, I would say that it shows that silver hasn't got much downside, in my opinion. Of course, some people even think this ratio could go higher. Who knows? It's possible. But I think it closed the week around 80, just below 85, 84.76. What about the stock markets? Well, let's look at the Dow. The Dow chart here, I've got 50, 100, and 200-day moving averages, black, orange, and green. It looks like for now, the Dow is finding a bit of support here just above the 200-day moving average. Still, consolidating here after the big drop we've had since the beginning of October. S&P and the Nasdaq, though, don't look as good. You can see here the S&P, the 50-day has crossed the 100-day, which is not a good sign, because in a bull market you want the 50-day to be above the 100 and the 100 to be above the 200, which it still is here, but this is not good. So, and the price is below all the three moving average. And the Nasdaq is even worse, I would say. And the Nasdaq, as we know, the FANG stocks have led the rally in the last few years. So I think it's significant that we are even, the 50-day is even quickly approaching the 200-day here. And we're way below all the three moving averages. So to me, the stock market still technically doesn't look great. I know there are some people who are speculating that stocks could rally into the end of the year, and that's possible. But that's why there's a market. There's bullish and bearish views. To finish off, I just wanted to show you a headline I saw this morning. It says on Bloomberg, Pence Xi showdown at APEC shows U.S.-China divide only widening. APEC is the it's a meeting of Pacific Basin countries, and the U.S. is part of it, of course, because California and the West Coast is in the Pacific, of course. And they've met today, I guess. And it says here, Xi says moves to implement tariffs were doomed to failure. Pence tells Asia that U.S. offers better option than China. And I'll read here a little bit. And this doesn't sound great. It says U.S. Vice President Mike Pence traded sharp barbs with Chinese leader Xi Jinping in back-to-back speeches at a regional summit, showing that neither country appears to be giving ground in an escalating trade war. Xi received applause Saturday when he told the Asia-Pacific Economic Cooperation Summit in Papua New Guinea that implementing tariffs and breaking up supply chains was short-sighted and doomed to failure. He called for a stronger World Trade Organization and defended his signature Belt and Road Initiative, saying it's not a trap as some people have labeled it. Speaking moments later, Pence told delegates the U.S. offers countries in the region a better option for economic and diplomatic relations than Beijing's heavy-handed approach. He warned against China taking Chinese loans, saying the U.S. doesn't drown our partners in a sea of debt, nor offer a constricting belt or a one-way road. Well, that's rubbish from Mike Pence, because the U.S. has been indebting through the IMF and the World Bank many countries since World War II. So, who has the veto power at the IMF? It's the United States Treasury. So it's not going to get better, I don't think, this. So there you go. A bit longer, this video, but it is the weekend. If you enjoyed it, please like, share it far and wide. Subscribe to the channel if you haven't yet. Just press the red button below. Yeah, you can watch me also on Steemit, DTube, and on Twitter. I'll talk to you later. Take care. Bye.